Authority.
Two-day slide on the S&P. Will it become 3? About 20 seconds away from the opening bow. Futures lower by 0.2% on the S&P 500. Three-day slide already on the Nasdaq. Down again on the Nasdaq 100. Will that become 4? We're down about 0.5% on the Nasdaq. Equities softer through the week off the back of weaker than expected economic data. As the opening bow, switch up the board and get to the bond market. Yields shaping up as follows. Lower again on a 10-year. A break of 330. 329.39 on a 10-year yield. We're down a single basis point, maybe even round it down to down 2 basis points on a session so far. In the bond market at the front end, we give up some of the move from earlier this morning. The 2-year now basically unchanged at 378. Yesterday had a little look at the 360s. Euro dollar having a little look at 108 right now. A break of 109. We're down about 1/10%. Weaker euro, 108.93. And crude, let's call it unchanged. We're down about 1/10% there. $80. We hold on to 80 on WTI. $80 and about 50 cents. About 30 seconds into the session, your equity market taking shape. We are lower by 0.2% on the S&P. On the Nasdaq, we're down about 0.4%. One stock to watch at the open is Costco. Shares falling after posting its lowest U.S. sales growth in nearly 3 years. Abby has more. Hey, Abby.
Well, John, this is the worst fall for this stock of the year, and it has to do with that weak comp sales growth. Folks disappointed. Now, if we take a look at the quarterly version, same-store sales, we are going to see the direction of what's going on here. Back during the pandemic, when you had folks stockpiling and also looking for this big box retailers discounting, same-store sales of 17%. The last quarter just closer to 6%. For the month of March, up just 0.9%, excluding the effect of gasoline. So this is really, these numbers moving in the wrong direction. It's the smallest gain since April of 2020. And the bigger point here, John, of course, is the strength of the consumer. If consumers are not flocking to a big box discounter for those discounts, where are they going? Are they just really slowing down their shopping overall? You know, it's interesting, though, because this stock has outperformed on the year the overall staple space, but we can see with today's decline, it's coming back in line. And one big question here would be, up 15% at one point earlier this year, are we going to see it even out and really perform just in line with that staple space, which is about flat on the year?
Down more than 3% right now. Abby, thanks for that. Different story for FedEx, as you know. Shares touching a 7-month high, with a number of analysts raising their price targets on the courier's new cost-cutting strategy. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. We're up 0.6% on FedEx 24 hours after the restructuring, where FedEx will merge its ground and express units. The highest level since August on the stock. It was a somewhat muted reaction, all told, by the end of Wednesday's session, up a percentage point or so off a session high of 4%. But we do see a number of analysts raising price targets. They're basically calling out that simplicity is key. They feel that this integration of the two units and simplification of the business structure will take time. But if you think about what Morgan Stanley is saying, for example, through Ravi Shankar, it puts the company on a path to what he calls the holy grail of integration gains. It's a more simple entity, according to Jefferies. At the end of the day, I guess, John, that when one way of looking at cost cutting is to tighten the belt, the other is just to go back to basics of your business, and the street's certainly cheering up. We're now up 0.8%.
Some cost cutting is easier than other cost cutting, and we're going to talk about some of the difficulties Amazon and Google are having a little bit later in the program. Ed, stay close. I want to build on this story from FedEx. Plenty of upgrades. Raymond James had this to say: upgrading shares to outperform and writing, quote, integrating its primary express and ground offering, focusing on attacking costs and enhanced capital allocation scrutiny, all set the stage to drive improved shareholder returns. Were management to be even remotely successful, then we'd see material earnings and free cash flow upside in the coming years. That stock's up again by 0.9%. Let's get back to the earnings. Shares of Constellation Brands topping profit estimates and boosting its quarterly dividend by 11%. Isabel Lee has more. Hey, Isabel.
Hi, John. It was a mixed bag for Constellation Brands, the producers of beer, wine, and spirits, the likes of Corona and Modelo. Shares of the company fell after the company reported revenue falling short of estimates. The company posted a net profit of $223 million, which is down around 44% last year. Sales also fell to 5% to $2 billion, which is slightly below forecast. But adjusted EPS came to $1.98, which is beating estimates. Here's a breakdown. Beer sales fell 2% after beer prices price hikes last year slowed consumer demand. Wine and spirit sales also falling 9%. Those categories also saw a big expansion in operating margins. Some silver lining, the company is now expecting adjusted EPS that's higher than estimate and raised its dividend to 89 cents from 80 cents per share. The stock overall has fallen around 5% in the past 12 months, so we'll see.
Isabel, thanks for that. The latest on Constellation Brands. Looking ahead to next week, it's going to be about the earnings from the big banks. The dates as follows. On the 13th, First Republic, which is a name a lot of you have been following over the last few weeks. JP Morgan on the 14th, so that's Thursday and Friday. Perhaps Western Alliance in the last couple of days has shown us how not to do it. They provided us with a little bit more clarity around their deposit base just yesterday. That stock is now up by 2%. Kaylee has more out of DC. Morning, Kaylee.
Well, good morning, John. It took them a hot second to actually provide that clarity on deposits because first on Tuesday, they put out a statement updating their financial status, no deposit info included, and then midday yesterday finally put out that information, which helped the stock come off of the 19% drop it had at one point yesterday. We are seeing a bit of a recovery this morning with the stock up roughly 2% at the open here, but that deposit figure came in less bad maybe than anticipated. Yes, deposits were down 11% from the end of the fourth quarter to the end of the first quarter of this year, came in at $47.6 billion at the end of March. But perhaps some good news coming in the fact that a larger share of those are insured, about 68%. And the bank says that the situation has stabilized as of March 20th, and they actually had $1.2 billion in deposit inflows in the first 4 days of this month. So the question really is now, is the worst over, not just for Western Alliance, but regional banks largely who have been struggling with deposit outflows as there remains a lack of clarity around policy, around insurance, and of course we have signs stacking up of a weakening economy. So all of that is in focus for these stocks that have been brutally punished this year. Western Alliance has lost half of its value year to date. First Republic down 89%. Regionals as a whole down nearly 30% over the span of just a couple of months, John. So the question is going to be now, as we look at these earnings reports, what they say about those deposits and, frankly, just their health overall, John.
Looking forward to those earnings coming out next week. Kelly, great coverage as always. Kelly Lyons there down in DC. I keep returning to the calendar. What a week we've got lined up. Tomorrow morning payrolls. On to next Wednesday on the 12th CPI. The 13th First Republic. The 14th JP Morgan. And a ton of bank earnings in between. This is where we stand right now. Equities down about 0.4 on the S&P. More weakness in the NASDAQ again. The composite there down about 0.75% on the NASDAQ. Even with, this is your backdrop in the bond market, yields lower again. On a 2-year by 2 basis points to 3.76. Cameron Dawson and New Edge Wealth looking ahead to earnings and writing the following. Yields dropping in the face of weak PMIs suggest that there is more earnings risk on the horizon, but that has not been reflected in estimates just yet. Cameron, I'm pleased to say, joins us now. Now, Cameron, you've put it in the way that I've been asking. Is bad news just bad news?
Well, if you base it on the last 3 days, it certainly seems that way. It means that equities are starting to wake up to the fact that usually when you see pricing for a lot of Fed rate cuts and lower yields and a re-steepening of the yield curve after an inversion, it means that there actually is economic and earnings risk on the horizon. And what we've seen within markets is really just thinking on that easier policy will help valuations. But if you look at the earnings front, you're still pricing in flat earnings growth on a year-over-year basis in 2023, and then a 9% jump in 2024. If we have a recession at any of those points, those numbers are still too high, meaning that you have to revise them lower and that the valuations look even more stretched where we sit today.
Cameron, can you take any comfort from how the bond market's responded to the incoming data this week?
No, because the bond market is responding with continuously lower yields, and we're about to break some pretty important support for yields, which would suggest that the pricing in of those Fed rate cuts in the back half of this year, that the bond market is getting even more confident that those will actually materialize. But we are questioning if the Fed will deliver on those rate cuts. They continue to say that they see no urgency in order to cut rates. They're afraid of inflation coming back. So we have this widening chasm between what the bond market is thinking the Fed will do and what the Fed is saying it will do. So it certainly points to continued volatility, not just for equities, but also for bonds.
Now, equities right now on the screen, the NASDAQ's down about 0.8%. Cameron, this is even with another rally in the bond market with yields just a little bit lower this morning by a couple of basis points or so. Can you draw some conclusions about where you think this relationship between bonds and equities is going?
Well, within tech stocks and within growth stocks, we do think that they move too far too fast in getting to a huge valuation premium to the broader market. The fact that they traded to a nearly 40% premium for the tech sector just back last week would suggest that they were already pricing in a big, huge rate cut path and a much easier Fed already into the price where they were today. And they were ignoring the fact that just because they're tech or just because they're growth doesn't mean that they have complete earnings resilience. That if we do actually, well, it likely would shift again further away from the cyclicals into the defensives. And that has been something we've been seeing over the past couple of weeks. Cyclicals have really started to break down after they led the market higher from the October low. As we started seeing that no landing data, much better growth data to begin the year, and you did see cyclicals leading. But over the past couple of days, you've had some pretty big downside volatility in things like industrials and materials and even the semiconductors, would suggest that there is more growth risk on the horizon, and would suggest that as you look into more earnings uncertainty, that you want to lean more into defensives, so your classic defensives like healthcare, utilities, and staples, which have really lagged to start this year.
Cameron, a couple of years ago when someone said defensive, it wasn't just healthcare, utilities and staples, it was also tech. You touched on it briefly there. Do you think people still underestimate just how cyclical some of these names might be?
I think that we have to think of tech in very specific camps, because there are parts of tech that are highly, highly cyclical. So if we think about semiconductors, of course, very sensitive to global manufacturing cycles, hardware, very sensitive to IT budgets on a corporate basis, but software tending to be less cyclical. They have more recurring revenue bases. And so that does help them have much smoother earnings through the downside in the economic cycle. So there's probably portions of tech which will be much more defensive than other parts of tech. But if we look broadly, the index does actually have much better earnings performance in down cycles than you see in other cyclical industries. So back in 2020, as well as during the great financial crisis, tech did outperform on an earnings basis if you compared it to things like industrials or materials. But if we look deep underneath, it really was because of those more defensive parts of the tech sector.
Cameron, great work as always. Cameron Dawson there, who joined us a number of weeks ago and said, beware the bull steepener. The economic data is starting to validate that move in the bond market, and now starting to see some weakness develop in the equity market as well. Third day of losses on the cards on the S&P 500. Day 4 on the cards on the NASDAQ. On the S&P, we're down 0.5%. On the NASDAQ, we're down 0.75%. Yields just a little bit lower at the front end by 2 basis points on a 2-year 376. Your 10-year just sub 330 at about 328. Coming up, let's talk tech. Tech workers left in limbo amid cost cuts.
There's probably more to come, whether in terms of business failures, bankruptcies, layoffs.
That conversation up next.
there's probably more to come, whether in terms of business failures, bankruptcies, layoffs, which we're already seeing well up the wage and managerial spectrum, which is another thing that's different about this contraction, slowdown, whatever you call it, eventual recession, is the layoffs are happening more top-down versus the typical start with bottom-up layoffs.
Big tech layoffs are stalling in Europe. The same companies announcing job cuts here in the United States, struggling to let go of workers across the other side of the Atlantic. A Google spokesperson telling Bloomberg the following: "We've been working carefully through each country where reductions are taking place to fully adhere to local legal requirements, which are complex and take time." I said Ed should stay close. Ed's back with us now on the West Coast. Ed, are you telling me they're finding it difficult to let people go over in Europe?
Yeah, very difficult. The reality is that labour protections, particularly within the European Union, make it hard to enact layoffs where there has not been prior consultation with workforce bodies, and that's where the detail in the reporting is. According to one Bloomberg source, particularly in France and in Germany, Alphabet, the parent of Google, and Amazon are having to negotiate with work councils. These are company-specific, peer-elected groups that negotiate with management on what the size and scope and specific roles impacted by layoffs look like. Then you go to the specific jurisdictions and the specific companies. In Alphabet's case, parent company of Google, they are trying to find workarounds. So in France, according to one source, they're leaning very heavily into voluntary departures and looking at attractive severance packages that hopefully will entice workforce in that nation to leave, right, of their own volition because of the issues that are ongoing. That said, sources telling us that the resolution in that market in France for Alphabet is weeks away. And you have to remember that these are layoffs and cuts that were announced going back towards the end of last year. Another example, Amazon in France, for example, has offered senior managers a whole year's pay, 1 year's worth of pay, Jonathan,
wow,
if they resign. Then you go to the complications of the technology sector. How are they going to deal with the issue of stock grants and other compensation? Well, they're basically granting long-term leave to those employees that they're pushing to depart in order to allow them for their stock to vest and their bonuses to be paid out. So you can see the complication that's going on here. And as you point out, Google issued us that statement also acknowledging that in some markets, Romania, Greece, Austria, they're not going to try and do layoffs. Amazon declined to comment on the story.
Ed, can you give us some more clarity? Is this going to change their thoughts, the decision they made about cutting people off, or will it just make it more expensive to do so?
The cost of it, is quantified, in both Alphabet and Amazon's case, right? They put dollar figures on it in the sort of low billions of dollars. One thing that sources were telling me in Alphabet, the parent company of Google's case, is that there were layoffs that were made or announced, and very quickly managers realized that there were people on those lists that they really still needed. That's an example that we heard about in Twitter, for example, which is a very different ball game, but where there were people that were cut that were then asked to come back. I think the breadth of these layoffs has made it very complicated for big tech companies because they're finding that using a scalpel takes too long. So they come with a sledgehammer. This is also something we've reported in Meta's case, but may realize that actually roles they're eliminating are quite useful for the future. So they're having to do a rethink.
Interesting.
Time is the real issue.
This is fascinating. I'm looking forward to the program with Caroline Hyde in about 2 hours from now. I'm sure you'll pick up on this story. We've talked for years about the labour market flexibility here in the United States and the absence thereof over in Europe, and this is a perfect case study example of that taking place. Speaking of Europe, Credit Suisse, top executives facing bonus cuts. The Swiss government ordering their payouts to be cut by up to half or outright cancelled following the UBS takeover. Bloomberg's Jan-Patrick Barnett joins us now for more. Jan-Patrick, I have to say, when I saw this, I wasn't really surprised. Were you surprised?
No, not at all. I mean, bonuses were already frozen last month, and I mean, it makes total sense from a political perspective, especially if you are a politician who wants to be re-elected. You simply can't pay out bonuses in the millions, and on the other hand, you grant billions of euros for protecting this merger, for loss absorbing, which I'm pretty sure UBS will make use of. It's simply not a political message that you want to have out there. Of course, it creates a whole lot of problems for the new company, UBS, Credit Suisse combined internally, because also not every manager is responsible for what happened to Credit Suisse. And if you've done a decent job in your area of responsibility, and you're now being one of those whose bonus is being cut or even outright suspended, it's probably not being good for morale. And maybe you want to look somewhere else, and that will make it harder for the new company to keep the high-performing talent on board.
Jan Patrick, you and I talked earlier this week about what Colm Kelleher had to say, the UBS chairman, about how long this integration could take, maybe up to 4 years. When do you expect to see the headlines, the real news about the degree of job cuts we might get from that combined entity?
Well, I would expect that we see something in the next 2 weeks. I guess they will need to figure out some details here. And you just spoke about like labor rules in Europe, and they are also very strict in Switzerland. So there's a lot to figure out there. But we have the UBS earnings coming up at the end of the month, and I'm pretty sure that they want to present at least some roadmap what they want to do for the next couple of weeks and months. And so I would expect that we see more of details and more of planning coming to light in the next couple of weeks.
April 25th is when we get that earnings release. Jan Patrick, thank you, sir, as always. Just the latest developments in the job market, both in tech and in finance, both in Europe and in the United States. Let's get you some sector price action. Equity's a bit softer this morning. Here's Abby.
It certainly is, John. We're looking at a third down day for the S&P 500, as you have mentioned, the longest losing streak in about a month. And it's a risk-off sector tone. It's very interesting because the only sectors higher today, they're basically those defensive sectors, utilities, healthcare, real estate. Real estate's not officially defensive, but it has dividends. So folks are looking for those dividends, that safety, especially as yields fall. Tech and consumer discretionary mega cap tech down about 1%. Let's take a look at that sector over the last 4 days, along with the banks, actually, and this is the last year. But over the last 4 days, both of these sectors lower. You can see over the last year, we certainly have tech outperforming, a lot of this having to do with the recent snafu, of course, with regional banking.
It's tech outperforming in the monster way year today. Abby, thanks for that. The Nasdaq doing tremendously well year today. On the session, not so much. We're down about 0.7% on the Nasdaq. Call it 0.8% lower on the Nasdaq 100. We're down 0.4% on the S&P. Busy morning tomorrow morning. Payroll's just around the corner. Busy week next week as well. Your trading diary up next. The yield on the 2-year lower for 5 straight sessions, capturing some of that weakness in the data, and the equity market responding with bad news just Meaning bad news, we're down about 0.5% on the S&P. Jobless claims, the wrong kind of upside surprise a little bit early this morning. The Nasdaq down 0.8%, even with that move developing in the bond market. That's the price action. Here's your trading diary coming up. St. Louis Fed President Jim Bullard speaks at the top of the hour tomorrow. The main event is payrolls Friday. We'll look out for that. More Fed speak coming next week with Williams, Kashkara, Harkey, and Harker and Goolsby all coming up. FOMC minutes and US CPI coming up on Wednesday, PPI and another round of jobless claims on Thursday. Look out for our special coverage tomorrow morning. It starts at about 7 a.m. Eastern time. We'll be catching up with Priya Misra, Ellen Zentner, Mohammed Al-Arian and Randy Krosner. Looking forward to that. For the rest of you, enjoy the long weekend. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, April 6th. Here are the top market stories that we're following for you at this hour. Job market cracks. You got claims rising. The latest sign that the job market's loosening with job cut announcements of 15% in March. Next up, payroll Friday. And bond bulls, are you right? Are you wrong? The two-year yield treads water, but down almost 50 basis points in a week. While equities trade a bit heavy, we get the positioning ahead of the jobs number. And what's your dream car? So the team weighed in today, and the VW Bug got some votes. We're going to speak to the CEO of Volkswagen America unit ahead of the New York Auto Show. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I feel like we've been slogging through this week, waiting for the payroll number, and we're kind of calming down a little bit as we head into that.
Well, I think everybody's waiting, but are they basically anticipating a continuation of a theme, i.e. the data throughout this week has been progressively weaker? You see it in today's claims number, which technically I think probably are down, not up, but it's all about the revisions. But you had the ISM, you've had a whole range of data this week, which has basically pointed us towards an imminent recession. But maybe that recession isn't quite so imminent. The market is pricing in a lot of cuts. We've seen a huge bid coming into the 2-year this week, Alex. The question is, does that set us up correctly or incorrectly into that payrolls number?
Yep, and all about timing too. Like, is it possible the markets have it right, but it's a timing issue? I mean, if you keep fighting the market, you can keep getting it wrong. And it's such odd. You have a fundamental view and then a market view, and they can actually be different right now. So we're going to try and unpack this over the next couple hours as we head into Friday's payroll.
We've also got a whole bunch of other data that I think we need to digest as well. Remember, we're going to get all this banking data, which is going to tell us about the stresses in the banking system. Is that fading? We get CPI next week. We're bigging up the payroll number. Of course it's an important piece of data. Is it the piece of data? Anyway, let's talk about where we are and where we're going. How are we positioned into this number? Claims for US unemployment, a little up. We got a big revision to last month, so technically they are down. The big focus tomorrow, though, of course, is the jobs number, consensus 235. That's the expected number in March. I would take a look at the wage number as well to give you an idea of what is happening around the consumer. Let's set it up for you. Let's get an idea of what we should be looking for. To do that, we turn to Bloomberg's Molly Smith. Molly, what are the key numbers we should be looking for tomorrow?
So for tomorrow, we're looking at probably what's still going to be a pretty strong month of hiring, around 240,000 increase for non-farm payrolls is currently the estimate, and for the unemployment rate still holding at a historically low level. Maybe some moderation on the wage pressure side, but overall still looking at a tight jobs market that's maybe moderating slightly.
And when we come to tomorrow, what kind of wage gains are we going to be like? Well, when you dig through the details, what are going to be those spots that you think are really going to be moving the market?
I think what it all really comes down to is what the Fed has told us is that the wages in the service sector are really what is so important to them right now, and particularly in some of those industries like leisure and hospitality at the lower end of the spectrum, where you've just been getting really outsized pay increases that are not consistent with the 2% inflation.
All right, hey Molly, thanks a lot. We appreciate the setup for us. Molly Smith joining us from Bloomberg. So that leads us to the question of the day. Are markets positioned for poor payrolls? And do we have like an asymmetric risk headed into tomorrow? Where Matthew Rowe, Nomura Private Capital Head of Cross-Asset Strategies and Senior Portfolio Manager, joins us now. Matt, how are we positioned here?
I think we're positioned to walk a very fine line. There's a bad scenario and there's a good scenario here, and the market's looking for the perfect number. It's kind of like the three little bears. They want just right. Because if the number is too hot, the reaction will be one way. If it's too cold, it will be another. I think that there's a little bit of a hint this morning in the direction, and the market's taking it as such. I think one read-through to this, too, into the end of the year is that there is the potential that we need to slow down rate increases because of a recession. They may not get the outcome that they want. So it's still reading through the tea leaves and picking up clues along the way.
Matt, is the labour market where we should be focusing our attention right now? We've got banking data coming out a little bit later on as well that's going to tell us about the stresses, particularly in the regional banking sector. We get CPI next week. Are we over-focusing on the labour market? Because that's been where it's at recently. Should we be looking more at these other pieces of data to give us a sense of where the markets are going?
Yeah, I think it's an easy and attainable piece of data, and it's a very important piece of data to look at the impact of the policy on the broader economy. I think you're hitting on something that's important that I've read about a couple times this morning alone, which is earnings, right? So the whole point of raising interest rates is to cool things down. It's to slow things down. And they're trying to walk that fine line of bringing inflation down to the target while not creating a hard landing. It may not be a possible thing to do. It's yet to be seen. But we should see weakening in earnings. We are seeing in credit markets increased cost of capital in the high yield market and things like that.
Why isn't, okay, well, is that reflected in equity pricing?
I don't believe that it is.
And why not?
Well, I think it's part of a bad habit that's lingering from the global financial crisis. And the whole intention of QE and accommodative policy is to push investors out on the risk spectrum. And taken to its extreme, levered equity exposure was a replacement for yield. Now, all of a sudden, we're back to a market where you have a company like Citrix doing a bond deal, a subordinated debenture, with a 14% yield. The high yield market issuance hasn't been this low since 2008. So under the surface, the credit markets are a bit frozen. We saw a little bit of a blip of issuance from energy companies opportunistically issuing high yield debt on the heels of the jump in crude, but beyond that, it's been a very cold market.
Under the surface in equities, Matt, isn't there though some evidence that we are already seeing the impact of what Torsten Sachs says at Apollo is a credit crisis, a credit crunch that is already here? The Russell is underperforming. The NDX is outperforming. Is that a trend that's going to continue? You would expect smaller companies to be more exposed to this credit tightening. Is that trend going to continue, or do you think we should start positioning for maybe a reversal?
Yeah, I think when you look at the month of March, it's an interesting little snapshot. The S&P was up a little bit, I believe, maybe close to flat. The NASDAQ was up north of 5%, if I recall correctly, and the Russell was down over 5%. So it wasn't a matter of reducing equity risk. It was a matter of changing the type of equity risk that you're taking. And I think it's important to note that because, in particular, Russell 2000 companies tend to fund more in the high yield markets than your average companies. So you're seeing people moving away from that sort of what I would call the third node of a trinomial tree, or the jump to zero risk, which is the wipeout of equity and insolvency. You're seeing people move away from that. And that's one of the reasons why we're really focused on intelligent private credit investing and taking our time to opportunistically deploy in private markets in a diversified and flexible way.
Do people say that they want the dumb private equity investment? If you're the intelligent, they're like, we want the dumb one.
Yeah, well, there has been a parade of private investment that has been following that zero interest rate drive to put money to work. Now the vintage really matters. The terms of fixed income, of credit investments now are much better for lenders. It's more of a lender's market. So we're seeing that. Borrowers, that haven't been hitting the market. Issuance has been low. They don't like the terms. At some point, as we approach this credit wall of 2024, they're going to need to come to market one way or another.
Matt, just briefly, what kind of a recession are you guys factoring in right now? What's the base case? How hard is it going to be? We're going to get some sort of a landing here. What kind of a landing is it going to be?
Yeah, my feeling personally is that it's going to be a little bit worse than people are forecasting. I think we still have this lingering optimism around equity beta that is pervasive in portfolios. But recent situations like the regional bank situation and the situation with Credit Suisse, even with the alternative tier 1 capital, are bringing back what I like to refer to as the difference between probability and possibility, right? If you mark the probability of a company failing to zero, or the possibility rather to zero, then the probability is also zero. We're back to a point where people are contemplating, yes, you might lose everything as an equity investor. And there was a little bit of head scratching around some of these events. When it's all said and done, though, heavily levered companies, by design, if you're in the equity portion of the capital structure, you are at risk of losing everything, and the debt holders may walk away with value.
Matt, great to catch up. Really good to see you. Thank you for joining us ahead of the weekend. Matt Rowe, Nomura Private Capital Head of Cross Asset Strategy and Senior Portfolio Manager. Coming up, we've got a great conversation for you. We've got an exclusive conversation with the IMF Managing Director, Kristalina Georgieva. That is next. This is Bloomberg.
12 past 7 on the West Coast. We're a little early today. You can kind of see the difference in the sun there. Want to get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. Ed, the story I loved today was that, Google and Amazon have been paring back their workforce, but they're having a really hard time actually doing it in Europe. Can you walk us through this?
Yeah, so both companies have thousands of employees in countries like France and Germany, and what it really comes down to is that within the European Union, labour protections make it extremely difficult to enact layoffs if there has not been prior consultation with relevant works bodies. So a Bloomberg source has told us that in the case of Germany and France, for example, they are negotiating with work councils. Work councils are peer-elected groups, company-specific, who negotiate with management and say, well, hold on, if you want to do layoffs, what do the size and scope of those layoffs look like? What are the roles that are going to be impacted? And in the case of those jurisdictions, according to sources, we could be actually weeks, if not months away from a resolution in those markets because of that hold-up. And what we find as a result is Alphabet, the parent of Google, Amazon, are trying to find workarounds, ways that they can do headcount reduction to deal with this situation without doing sort of hard and fast layoffs.
Where is this most acute? What does it mean for workers?
Yeah, it's certainly most acute in Germany and France. I mean, what it means for workers is potentially big pay packets. So, for example, in France and Amazon, the company is offering senior managers a whole year's worth of pay if they choose to resign. It's somewhat of a severance package, according to sources, but also, a carrot saying, here's 12 months worth of money. Where it gets more complicated is think about how tech companies pay their most tenured staff. Stock compensation and also in bonuses. And what sources are telling us is that in the case of France and Amazon, they're basically allowing people to go on leave, basically paid leave, to give time enough that those staff can see their stock granted and their bonuses paid. Really financially impactful for those tech companies.
Yeah. Sounds like kind of a good deal. I don't know. I also wonder if it's going to wind up hurting how they're going to hire in the future as well, particularly in those countries where it's hard to fire. Anyway, Ed, really appreciate it, Bloomberg's Ed Ludlow. And don't forget to catch Ed as co-host of Bloomberg Technology coming around 90 minutes time at 12 p.m. Eastern and 5 p.m. In London. Okay, taking a look at the markets, look at the NASDAQ 100 off by 0.2%, the S&P barely off. Industrial is actually starting to outperform here within the S&P. The other main headline is the IMF and the World Bank are kicking off their annual spring meetings this week in Washington, D.C. Joining us now from there is Bloomberg Surveillance co-host Tom Keene, along with IMF Managing Director Kristalina Georgieva. Tom?
Good morning to all of you on television and radio worldwide, and particularly on the Pacific Rim and China. A timely conversation with the Managing Director of the International Monetary Fund. Kristalina Georgieva joins us, and what's so wonderful here, she's a trooper. She's got the plague like all of us have had over the last number of weeks. And to the speech you just gave, you were struggling through it with what we've all got right now. There's so much to talk about. We were going to do a 2-hour conversation, and we've got to squeeze it down to 10 or 12 minutes. Let me get the math out of the way first. I was thunderstruck in your speech and what your World Economic Outlook says about a 5-year vision of the International Monetary Fund of growth from 3.8% down to 3%, a 21% decline in the 5-year vision. Are you modeling global recession, and dare I say global recession, for 5 years?
What we're modeling is a period of slow growth that is being held back by a number of factors. One is not so dramatic. Some of the fast-growing economies like China or South Korea are growing fast no more. But you would expect that there would be others to pick up the torch of strong growth. And this is not happening. What is holding growth back are 3 groups of factors. First, low productivity. We have been struggling with this phenomenon before the pandemic, and we continue to struggle with it. Second, it is fragmentation. The fact that the world economy does not enjoy the same impetus that comes from more trade,
you understate it.
more
We're going to spend this entire interview on trade fragmentation. Give me the third point right now.
And the third point is that countries that we would expect to add to growth, frontier markets, low-income countries, are in particularly difficult place because they have been innocent bystanders of repetitive shocks. The COVID, Russia's invasion, the fact that the world economy as a whole is now less able to support the weakest members. Why? The peace dividend is gone.
Well, and we're through COVID, and it is a celebration of these meetings as we come beyond COVID, the assistance of you and other institutions in getting us beyond this pandemic. But you end your speech talking about the ropes that tie us together. The ropes between Washington and Beijing are frayed as you and I haven't seen from our youth. How does the IMF tie the ropes between Beijing and Washington back together?
Where we see an opportunity to do better is to identify very practically areas where cooperation is a must. Climate change cannot be fought by individual countries. The criticality of adjusting to more supply security at the lowest possible cost. Engaging on securing areas of the world that have become more fragile. It is in everybody's interest that we do not have more civil wars, more conflict.
Right, but in everybody's interest, in the tone here, and particularly in the Economist article of 2 or 3 days ago, is China doesn't want to participate. Now, you spoke in your comments in your speech of the new practicality of the Premier of China. Can you report that there's a new practicality out of Beijing to help us with those ropes to tie together?
What I heard in our bilateral meeting and also publicly from Premier Li Qiang are 3 important messages. First, China's commitment to continue to open its economy for private investors from all over the world. Second, China's commitment to play a constructive role in multilateral institutions, including the IMF. And third, China's commitment to support developing countries that are struggling with high debt levels. For many of them, China is a major
What's
creditor.
so important here, and this goes to our Anne-Marie Horton's conversation with the Speaker of the House last night in Los Angeles, but to take it away from the politics and go back to IMF 101, the Chinese don't want to participate in the normal and historic IMF restructuring process. They don't want to extend duration. They don't want to take a haircut and bring down the interest rate. They don't even want to write down some of the debts that they were directly or indirectly involved in. I spoke to our Matthew Hill in Mozambique on Zambia today. Can Chinese help you with the challenges of Zambia?
What I am very mindful of is that China has been very slow to recognize that multilateral debt restructuring requires China to play by the rules that are already established. It is now the time for China to demonstrate that they are capable of playing by these rules. Yes, we have had very slow process on debt restructuring on Chad, but we have completed it. We have now initiated a debt restructuring for Zambia, and I got the assurances from the Chinese premier that China would play its role. They are the largest creditor to Zambia, for Zambia to move to a more reliable path. The same applies to Sri Lanka, where China has taken a commitment to play by the international rules. The same applies to Ghana, to Ethiopia. We have created, together with the World Bank and India as G20 presidency, a new global sovereign debt roundtable China is participating.
They're
fully.
part of that roundtable.
They're part of it. They're participating fully, and they're participating constructively. Where we need to continue to engage with China is on how we can achieve the same result for countries in terms of shrinking that level that China can implement domestically given their own internal domestic constraints. Direct haircut is the most straightforward way, but we can achieve the same shrinking of debt through that reprofiling. In other words, extending by many more years the time of servicing.
Does China agree to that traditional methodology?
They are not, well, they have agreed in the case of Chad. We are now working on having them agreeing in the case of Zambia. But look, proof of the pudding is where? It is in the eating. So I can say we got reassurances from the Chinese leadership that they would play constructively.
Right.
Now we need to eat the cake. Now we need to see China delivering on this.
How urgent is it, and as you said in your speech, as you start these spring meetings, this difficult climb? How urgent is it for President Biden to meet with President Xi to begin the path of practicality and the path towards the huge tensions that we have now, to improve those tensions?
Well, this is for the leadership of these two countries to decide. What I can say is that when there is so much tension between the two largest economies, then the innocent bystanders are being hurt. We calculated the economic impact of the tariffs U.S. imposed on China. For last year, this shrunk global growth by 0.4%.
Oh, you underplay it. Come on. It's a working paper of the IMF, and basically we're shrinking Japan and Germany out of the global system, right?
Well, no, this is a separate issue. I'm talking specifically about the tariffs.
Okay.
The tariffs that have been imposed, they reduce global GDP because the impact of trade restrictions, we know it from history.
I'm running out of time here. I've got to make some news. Are you suggesting that President Biden should eliminate or diminish the Trump tariffs?
We think that getting on a path of less fragmentation in the world economy is good for everybody, including for middle class in the United States. Because when we impose more costs, they trickle down and somebody pays. Who pays? It is in the end consumers here, consumers everywhere. So less fragmentation in the world economy means higher standard of living for people everywhere.
You need, I know that I've had the plague and I needed to get a lot of rest here, and I know my colleague John Farrow has the plague. Now you need to get some rest before these spring meetings.
I do indeed.
The next time we talk, it's going to be a 2-hour conversation. She is the managing director of the International Monetary Fund, Dr. Kristalina Georgieva. Now back to you in New York.
Tom, thank you very much indeed. Such a useful conversation, such a great setup for what comes over the next few days. Tom Keene in conversation with the IMF's managing director, Kristalina Georgieva. Okay, let's talk a little bit about what we've got coming up for you. Markets going into a long weekend. But we've still got to get over the hurdle of payrolls. We've still got to get over the hurdle of all of this data we're going to get from the banking sector. Remember, next week we get CPI as well. A more cautious tone, therefore, going into this weekend. You can see that in the equity markets. The S&P is down by around 0.2%, as is the NASDAQ. We have had some outperformance from the tech-heavy index over the last few weeks. Does that persist? We're going to try and set you up for the next few days. Diane Swank, KPMG's chief economist, joining us next. This is Bloomberg.
all day yesterday.
We're about an hour into U.S. trading session. I used the word slog yesterday, and that's definitely what it feels like. Like we're slogging towards the end of the trading day today and then to the futures trading tomorrow with the jobs number. Abigail's tracking some of these moves for us. Abigail?
I love that word slog. It does feel that way because we have pretty dramatic moves here, but it really doesn't somehow feel like much. It still feels like a slog or sleepy or traders are treading water, but nonetheless, you have the NASDAQ 100 over the last 4 days, basically this holiday shortened week, down about 2%. The longest losing streak going back to February 22nd. This is yields decline, so it's a little bit unusual. And of course, there's lots of talk of folks thinking that the economy is really slowing and maybe getting out of these big tech stocks. I would suggest that it also has to do with some consolidation of this year's 20% rally. Still a big rally even after this little bit of a decline here. As for what's dragging on the day, it's not just tech. Take a look at Costco. Surprisingly enough, this is the top point drag and a big percentage drag on the NASDAQ 100, down 3.3%. Their March comp sales coming in up just 0.9% when you exclude gasoline. That's the slowest growth going back to April of 2020, putting into question whether or not the U.S. consumer is slowing. So it's an interesting piece of information coming in line with some of this softer data that suggests maybe that is the case. Tesla and Apple, some of the bigger point boosts even or drag, despite the fact that the declines aren't huge. And then Airbnb down 4%. So this is a slice of what's happening in the NASDAQ 100. As for the technicals, let's take a look at the RSI in the NASDAQ 100. It's not entirely clear what's next. So of course, when we go above 70, that is overbought. When we go below 30, oversold. This is a momentum indicator. And earlier this year, we were above 70, overbought. And then on the February pullback into March coming in, it's not clear, though, that we're going right down. This trend right here, this near-term trend hasn't been broken. It wouldn't be surprising if we actually then pop higher up into overbought territory, which Ari Wald over at Oppenheimer likes to remind me that overbought is not necessarily a bad thing. It actually signals strength. The key factor, of course, will be that jobs report coming out tomorrow. If we take a look at the trend for non-farm jobs payrolls, I believe that the estimate for tomorrow is somewhere right around 230,000 jobs expected to be added. So this is the last 2 years, and you can see that overall the trend is actually flat over these 2 years, but with lots of massive moves. If it does come in at 230, of course, it is going to be at a bit of a decline. But Guy, last month, I believe there was this big blowout surprise. So it's going to be very interesting to see what happens. I know that we'll be covering it here on Bloomberg, but many people won't trade, traders for stocks certainly won't be available. So maybe that reaction will be on Monday.
Absolutely. We're going to get some great coverage, though, as that number comes out. I know the team is standing by to deliver that. Abigail, thank you very much indeed. Abigail setting us up nicely for our question of the day. Are the markets positioned for a poor payroll number tomorrow? Joining us now, Diane Swong, KPMG's chief economist. Diane, over the last week, the US 2-year is down by 35 basis points. Is that 2-year move consistent with the kind of number you're expecting tomorrow for payrolls?
Well, we're looking at payrolls to certainly slow to around 200,000, a little lighter than the overall consensus because of the seasonal factors that helped to juice the payroll gains earlier this year are starting to reverse in the month of March. We saw that in the unemployment claims data today as well. That said, I think it's really important to look at some of the headlines you just riddled off, and that was that we're seeing some momentum in the consumer, some cautiousness there, and the spending momentum index by Visa, which is really an interesting diffusion index, it showed that 2022, even though we generated an extraordinary number of paychecks which helped to buoy aggregate demand, individual consumers were showing much less discretionary spending, much more caution in their spending behaviors, and we've been seeing the saving rate actually rise since the fourth quarter right into the first quarter and into February. So I think those are very important trends to watch, that softening, and how much does that softening become a slow stall as we get into the summer.
And then adding to the stall is the potential credit crunch. What is your timeline and read through from, say, the potential credit crunch into the real economy when it comes to jobs?
You know, it's really interesting is the Kansas City Fed just did a study on the sensitivity by sector in employment to interest rate hikes, and the least interest rate sensitive sector is the service sector. And of course, here we are still with revenge travel very robust. That is helping to buoy the service sector and service sector inflation, which is what the Fed's so concerned about, which means we have to overshoot on the other side on all other sectors of the economy, which is why we're so concerned. Our view is that we'll start to see a real crunch and a decline in employment as we get into the summer, but small declines. This is really, like I said, a slow-moving train wreck rather than, you know, a collision or a cliff event like we've seen in the past. That's what the Fed would like to see. That said, there's a lot of non-linearity to once you start to see unemployment rise and employment slow or actually decline, it's very hard to contain.
Yeah. And it does, as you say, tend to accelerate quite quickly. What does that mean for inflation, Diane? Because the big conundrum here is, you talk about this being a sort of slow train wreck. Is that slow train wreck enough to bring inflation down as quickly as the Fed would want? The market is pricing in cuts from June. But what happens if inflation doesn't come down? Does the Fed just kind of stick with it? Maybe it raises another once, maybe twice, and then sit there, because that's not what the market is pricing right now.
Well, that's the issue. It's the question of what the Fed wants versus the market wants. They're two different things, right? The Federal Reserve is talking about higher for longer and holding monetary policy restrictive even as inflation begins to cool, because they think this is a marathon, not a sprint, and will take a very long time to slowly erode inflation. That gap between market expectations of a quick turnaround and a quick cooling in inflation is very different than what the Federal Reserve expects. It also is a big disconnect between the equity market and the bond market. The bond market expecting these big cuts that are really more commensurate with a deeper recession and deeper scars and a blow to profits. And I think that's where things are out of alignment. We're not seeing sort of you can't have your cake and eat it too, but the financial markets seem to want it to be that way.
Yeah, it is so confusing, because if we're looking at some kind of recession that's going to be bad enough that the Fed's forced to cut 3 times, almost 4 by the end of the year, like why would the S&P be over 4,000? What do you think then gives first? Like what do you think gives first?
Well, what I do think we're going to see is that it's going to take a little longer to get inflation down, even as the recession gains some momentum and we see a bigger contraction in employment and the overall economy. I see it as a slow process. It could be asymmetric. We could see it accelerate fairly rapidly over the summer if this is not, the financial crisis is not over yet. I can't speculate on whether or not it is, but we tend to know that manias and financial crises come in fits and starts, and so I'm certainly holding my cards back in terms of being overly optimistic. And I know that it's frustrating because many people say, well, we've been forecasting a recession for a while, so at some point in time we're going to be right. But the bottom line is the Fed is committed to really fighting and combating inflation here over financial stability and trying to divorce financial stability from rate hikes. That just isn't the case. You can't delineate the two. And I think that's what ups the ante of a larger overshoot.
Diane, how symmetrical is inflation? Does it come down as fast as it went up?
Well, clearly not. It already hasn't. And I think that's what's really important is we've already seen inflation become more sticky, especially in the service sector, which is over half of all inflation in the economy. So this is important to remember. And that's what the Fed is fighting against, because it knows historically, and history has not been the best guide, we know that, of this particular cycle, but historically, once it's gotten here for this long, it takes a longer time to come down. And financial markets keep going back to the world we knew pre-pandemic, where we had a hard time getting inflation up to 2%, let alone fighting and combating inflation.
I know, it is kind of crazy when you put it in those terms. I should point out that Jim Bullard talking about inflation, going to be sticky, reiterating just what you said, the Fed has to stay at it, etc. I just want to go back to the credit crunch for a second, because small businesses have really been the hirers, right? If they get hit hard, what is the potential for the job market hit?
You know, this is an area we've been studying like crazy, and it's not only just small but younger businesses. Businesses with less than 250 employees, more than 4 or 5 job openings are being dominated by those employers. And in fact, those with 5,000 employees and up have been declining their job openings, have been cutting job openings. And so they've been the buoyancy, the resiliency of the U.S. economy in recent months, and hitting the backbone of that, given the kind of credit tightening we're expecting, that really does undermine the momentum in the labor market. So we do see, that's why we do see it happening over the summer and actually job declines. Many small employers are out there and they have, are holding on to workers as long as they can, but that's only sustainable in a low interest rate environment. It's harder when those interest rates flip.
Diane, it's always great to catch up with you. Thank you so much for sharing some of your time with us today. Diane Swan, KPMG's chief economist. Okay, coming up, Volkswagen wants to accelerate its EV presence. We're going to get the details next from Volkswagen's North American CEO. This is Bloomberg. Okay, let's check in where we are with the markets. We're going into a long weekend here in Europe. I can tell you, take a look at the AVAT screen on your Bloomberg. You'll see that volume is really quite light for European equities. The Stock 600 is, though, in positive territory. What's interesting is the luxury sector that is actually acting as a bit of a drag today. It's been such a big driver of these markets over recent weeks. TUI actually talking about a positive picture, a pre-pandemic picture for travel this summer. So revenge travel continues. And we actually had some fairly good good data out of Germany today on the industrial front, which is quite significant. And maybe that is a harbinger of the fact that Germany potentially, if you take the data in aggregate, has the potential to maybe avoid a recession, which is interesting in light of what we're thinking about when it comes to the ECB. Alex.
We want to welcome now our Bloomberg TV viewers and radio listeners. The New York Auto Show kicks off tomorrow, and the top auto execs and gearheads are in Manhattan, or Matt Miller, who's sitting next to me here on the TV set. Pablo Deci is CEO of Volkswagen North America, and he joins us now here on set along with Matt. Matt, why don't you go ahead and kick it off?
Yeah, Pablo, first of all, I'm glad to have you here with us in studio. And you know, I've been following Volkswagen since I was a little kid. It's taken the brand a long time to get a foothold. There have been ups and downs in the U.S. market, but it strikes me that this wave of electrification, especially with the ID portfolio of products that you have out, is the perfect opportunity to really make some changes. Do you see it that way as well?
I could not have said it better, Matt. Thanks for inviting me. Yeah, we have a great opportunity in the U.S. I believe that this is the right time, the right place, and with the right government regulations. The IRA guidelines that were passed last week put a lot of incentives on the consumers to have locally made vehicles, particularly with an entire supply chain localization, which is exactly what we want to do here in the U.S., to become more local, to gather and cater to the American consumer.
It's actually always struck me that, you know, having lived on both sides of the Atlantic, I always like the German VW products a little bit better than the U.S. VW products, but what you want to do is bring a design team here. You want to create the look of U.S. Volkswagen products in the U.S. You want to create the user experience that Volkswagen products have in the U.S. Do you think that's going to help you boost market share? And what are your targets in terms of market share?
Absolutely. So first of all, I think this is a company-wide objective, right? From our group CEO, Oliver Bloom. We have the U.S. as a priority in our company for the next couple of years. And obviously, we need to have more tailor-made products made here in the U.S. and in the North American region. And the fastest way of doing that is to have design customer clinics, so you gain more speed and you have custom-made vehicles for the American consumers. So that will be our main focus over the next couple of years. How do we accelerate this trend? We are planning to have over 25 electric vehicles for the Volkswagen Group of America until 2030. So we have very aggressive goals to achieve in the U.S.
What kind of market share?
10% for the total Volkswagen Group of America and 5% for the VW brand.
How do you literally do that in terms of securing the supply chain? Like, where are you going to get your lithium? Like, where are you going to get the aluminum? Like, where do you get the stuff? And does that just wind up costing more for you guys?
So the first step that we have taken, and this has been in the works for a couple of years, is the announcement of PowerCo. We have a division called PowerCo that has recently announced that they will open shop in Canada. So it's a combination with the Canadian government, where we're going to be working extracting the minerals, the battery cell production, and the battery production, all in the North American region. And in addition to that, we have a battery assembly plant within Chattanooga. So we will be expanding our supply chain in the U.S.
I hear you. Is that going to be, though, more expensive going forward? I mean, I know you want to expand the supply chain, but can you get all your supplies? And it just makes me feel like cost-wise, that's just going to be a more sustained inflationary pressure.
Yeah. I think, you know, the IRA guidelines published last Friday were a great step forward for the auto industry and for the U.S. because they have clear guidelines what type of minerals from which country you can bring. So there are a bunch of countries that you can bring minerals and that you would still qualify for the credit. Now, having this partnership with Canada and with long-term contracts, and I think innovation, particularly in the battery production, will come in the next couple of years by utilizing less minerals or reducing the charging time in the vehicle. I think this will come in the next couple of years, hopefully reducing the price of the vehicle.
In terms of your advantages. You know, Herbert Diess set up Oliver Blume for, it's really a behemoth. I don't know if Americans know how big Volkswagen is and how much money you've spent on, building up a software unit, on building a platform for electrification. And you were talking to us earlier a little bit about digitalization. Can you get, cars for the American market designed and built more quickly now?
Absolutely. This is a journey, Matt, so it will not be from one day to the next. It's not going to happen tomorrow. But I think by bringing digitalization, engineering combined with the design, it will increase the amount of vehicles that we bring to the market, and it will decrease the amount of time. This would not be possible if we would not have the support from Volkswagen in Germany. Yeah, I know that Oliver Blume fully supports the strategy along with the board. Yeah, we have Arno Antlitz, and we have also the VW brand CEO, Thomas Schaefer. So everybody's supporting this strategy that we need to get more responsibility for the design and the development of the vehicles here in the U.S.
I was just down in Mexico, and I saw down there some of the original Bugs, right? And my heart flutters a little bit. It's such an iconic design. I grew up partially in Germany, so for me the Golf is almost synonymous with car, right? My mother has pined for a Volkswagen bus for the better part of my life, and I'm old. Are these iconic nameplates going to come back? I was worried when I heard the Golf. This may be the last generation of the Golf.
Yeah, so going to your point, they will come back. I mean, we're going to maintain the DNA of the brand, the iconic products. For example, we are launching the ID. Buzz in a couple of months. Here in the US, it will be a global launch. It will be in the beginning of June. And the launch of the product will be available in 2024. So these type of vehicles, iconic vehicles, we will preserve the DNA of the brand going forward.
There will be a next-gen Golf. We're going to still see a Golf in 2030.
We're going to maintain the DNA of the brand. Probably a Golf, I cannot guarantee you, but I guarantee you that the DNA of the brand of these iconic products will remain intact.
So that means you, have to buy your mother one, I think.
She's getting a bus. She's getting a bus for sure.
A bus, okay, so she's getting that one. So speaking of demand, what is your view on where the U.S. is right now in terms of recessionary fears, et cetera?
Yeah, so first of all, let me tell you that on the first quarter of this year, the market is growing 9%. So despite the recession fears, despite the inflation, and despite the interest rate, the market remains strong. And we have gained market share as VW over the last three months. So that's very positive.
How strong?
9% market growth is very strong. I mean, and we grew almost 10%. So I think that, yeah, there's inflation pressure, there's interest rates, obviously particularly on the lease when the consumers go to the dealer and they see that the lease has, almost doubled. It has an impact, but it has not slowed down the industry. Now, I think the Fed has made really good decisions on increasing the interest rate to keep the interest rate under control. I think this strategy will pay off by the year end, 2023, and I would expect that the interest rates will start coming down slowly early next year.
We've seen in the last couple of days a number of car makers put out news about their own finance arms, right? It's really important to have your own finance arm, especially in this kind of situation, high prices, rising rates. How do you plan to finance your growth?
So we do have
your customers.
So we do have a bank here in the US, a very solid bank. But again, it goes back to the product, right? So let me give you an example of the ID.4. which we started manufacture in Chattanooga in the state of Tennessee last year. It's our first electric vehicle manufactured in the US. Today, for the first 3 months, we're number 4 in the rankings in the electric vehicles. Yeah? And then on top of that, we have a company called Electrify America, which are charging stations, 300 charging stations, 3,500 superchargers. Yeah? We're going to double that in 2 years. And the most important thing is that 100% of that comes from renewable energy. Yeah? And then we give the buyer of the ID.4 up to 3 years, 30-minute charge for free, included in the package of the vehicle, which starts around $39,000. So when you're a consumer and you look at the total picture, an affordable ID.4 with free energy, renewable energy for the next 3 years, and you have some financing options, and on top of that you have the IRA credit, that's a compelling package.
All right, Pablo, thank you so much. I really appreciate it. Matt, also appreciate having you
Yes, I
here
do.
on set with me.
Oh, thank you for allowing me to come and join you.
Oh, you're welcome. Pablo DeC, Volkswagen of America CEO, and Bloomberg's Matt Miller. This is Bloomberg.
So we're coming into the end of the shortened week here in Europe. We've got Friday off. We've also got Monday off as well. So a little bit of risk maybe coming out of the market in terms of volume. We're certainly seeing a fairly light volume day. I think a lot of people have already made the decision to head off for their Easter weekend. The Stock 600 is, though, up. We are seeing maybe a little bit of a reversal in terms of what we've been seeing over the last few weeks, which kind of makes sense if you think about it. So commercial property stocks are a little higher today. Luxury stocks, which have been a huge driver of European equities, are fading. Airbus today up by around 1%. Remember, Emmanuel Macron is out in France. We've seen a deal done today for a new final assembly line for Airbus in China, which is interesting in terms of the risk that that company is taking, but not maybe getting the orders of A350s that they were anticipating out of China. Kering, emblematic of what we're seeing here today, down by 2.1%. The luxury sector is lower. We're going to talk about all of this in the next hour. This is Bloomberg. Thursday, the 6th of April, European equities are up, but volume is down. We head into a long weekend. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So European equities are up, but volume is down. You've got basically a reversal in terms of the sector story. Luxury is off. You've got commercial property higher. Basically, I think we're de-risking going into a long weekend. Some interesting stock stories, which I always think are worth focusing on. TUI, the travel company, talking about actually returning to pre-pandemic levels this summer. There is still a desire within the service sector to spend money. That is significant when you think about how central banks are going to react. The data out of Europe actually okay today. The industrial production data from Germany maybe painting a picture of an economy that, Alex, is not heading towards a deep recession.
Yeah, I also want to point out, too, that anecdotally when I went to Florence, they said the same thing. From hotel owners to restaurant owners to shop owners, they're all like, yep, this summer's going to be awesome. What's not awesome is the price action here. It is pretty sleepy. It is pretty dull. The S&P just off by 0.3%. I think, Guy, you're totally right. It's some de-risking into jobs. Friday, I will be here Monday, though, to pick up those pieces. NASDAQ 100 off by about 0.4%. All the sectors in the S&P are in the red. Now, interesting, I wanted to pick out Mosaic. Stock down 5%. JP Morgan downgrading the stock to neutral. And this is what I wonder if we're going to start seeing a lot more of this. Basically, the tailwinds that the stock had in terms of the Ukraine war and fertilizer prices and all of that upside, if that's going to slowly start to drain out now, and the economic environment's going to be a lot tougher for the likes of Mosaic, that's key. That's an industrial company. That's a big deal. And I wonder if we're going to start seeing that as we get into earnings season. Goldman Sachs definitely warning about that earlier today. 2-year yield down 2 basis points at 375. I should point out that 355 is the low for the year. It feels like, do we get there first or do we get to 4% again? Guy.
Absolutely. The bottom of the story I think is interesting. The macro is going to dominate over the next few days. I know we're heading into the Easter weekend, but we've still got payrolls to get through. We saw claims today. That was significant because actually the revisions I think were meaningful there and need to be digested. It could be the same thing when it comes to the payroll number. We get CPI next week, remember. We also get this banking data as well, which a lot of people are going to be paying attention to over the next day or so. How do we plug that into a market that is now pricing in cuts from June? We've seen, I think it's 35 basis points, the move this week in the US 2-year. The market is now positioning for Fed cuts after June. We may get one more hike, but maybe that hike is just a prelude to those cuts coming through. The interesting thing here, Alex, is this is not what the Fed is signaling. The Fed is still signaling that it's got some way to go, that it's going to potentially hold when it gets to where it's going, and that is a very different narrative coming through. But maybe the Fed's looking at rearview mirror data that isn't telling us what is really happening in the U.S. economy.
It is very confusing. Although Mester, though, making the point earlier this week that they do have real-time data that they also look at. So Torsten Slok, Apollo Global Management Chief Economist, joined Bloomberg TV earlier to talk about how the softer economic data will feed in to the Fed's mandate.
The Fed is trying to slow down hiring. The Fed is trying to slow down capex spending. So therefore, it should have real consequences. In other words, it should show up in GDP growth, in consumer spending, and ultimately in earnings.
Torsten Slok from Apollo speaking a little bit earlier on, talking about the credit crunch that is already amongst us in terms of the impact on the U.S. economy. Let's get back to our question of the day because we're trying to position for payrolls. Are the markets positioned for a poor payroll? I give you Exhibit A, which is the 35 basis points that we've seen coming off US 2-year this week. Let's discuss this. Bloomberg's Justina Lee and Liz McCormick joining us now to kick this story around. Justina, let me start with you. We have seen a big move at the front of the US curve this week. We're now pricing in cuts from June. The market is already signaling the cuts are coming. This is an economy that is rolling over. Does the payroll number confirm that tomorrow?
Yeah, that's the big question. I mean, so far, if we look at what the survey of economists is telling us, people are expecting a bit of a slowdown in the payroll growth. And I think that really will be really important because, going into tomorrow, everything from this week, or at least almost everything, has kind of pointed in one direction, which is that the economy is softening. I mean, we think about jobless claims. If we think about, the ADP jobs data yesterday or PMIs, ISM. I mean, it's a very clear message that we're getting out of this set of economic numbers.
So, Liz, what is then the risk going into tomorrow? If we take into account the actual data list that we might see, and then in terms of positioning, it just feels like there's an asymmetric risk here.
Yeah, that's what I think. And, to look at Canada's data today, their jobs data blew past to the upside of all the forecasts. So it does happen, right? And Justina's right. We've had a lot of weak data from the U.S., jobs included, but not the big number. So I think you're right, Alex, that the risk is, the pain trade is that this number, I think even if it comes out close to expected, that's not going to be enough momentum to kind of send yields even lower. If you look on Bloomberg, they have the whisper number out there. It's only like about 9,000 above the consensus. So it's pretty centered smack on around 230 job growth. So if it's around there or, higher, then I think you're right. We could see yields back up here.
Liz, earlier this year, we were in a position where we thought we had a runaway economy. The economy was much stronger than we anticipated, and we all got very excited about that. Is there a danger now that we are kind of overemphasizing the downside? The market is ignoring good news and focusing on the bad news.
Yeah, I think so. And it was kind of like such a whirlwind, right? We went from the great economy, now it's terrible. And, everybody's not buying in. Like I was looking at the guys at HSBC, Max Kettner was even, I think, on TV earlier. And he's like, we don't buy into this doom and gloom, or at the least shouldn't really come for maybe 6 months or so. So I think there are some people pushing back that we've gone too far to the extreme, that, even Governor Bullard was on today from the Fed saying, some of the lower rates, that is helping, kind of temper the issues from the banking crisis. So, I think maybe we've leaned too far the other side, but let's see. I think jobs, like we're saying, is going to be key. If that is a surprise, that's a problem.
So, Justina, to that point, what's the market in Europe going to take in terms of the signal to the jobs Friday in the U.S.? I appreciate your close Monday. I appreciate it's closed on Friday. But, is Europe just going to trade with the U.S. at this point, or are they diverging?
Yeah, and I think, the European market has always been more attuned to the ups and downs of the economic cycle. And I think, going into tomorrow, people definitely don't want a number that's kind of too hot, which would kind of completely rewrite the narrative around rate cuts coming up in the U.S. But at the same time, if it's too weak, I think there could also be a reaction in the other direction in the market, especially with equities kind of not really reacting in the way that you might have expected to all this bad economic data so far.
Where could the surprise come from over the next few days? I want to look at the sort of totality of the data that we're going to get. We're not just going to get payrolls tomorrow. We've also got all of this banking data that is going to tell us what's happening, particularly in the regional banks coming through as well. We're going to get CPI next week. Are we looking in the wrong place for a surprise?
Yeah, I think there's going to be a lot of attention on the banking data. People have kind of woken up to all this this data that they used to ignore about, deposits and kind of lending standards at banks. And I think, one thing that James Bullard pointed out that's pretty interesting is that obviously banks are kind of breathing a sigh of relief right now because with bond yields coming back down, it does mean that they're not losing as much money on these bond securities that are on their balance sheets.
All right, guys, thanks a lot. We really appreciate it setting us up for tomorrow. It's going to be hard to move the needle, though, it feels. Justina, thank you, and Liz, thank you as well. Both enjoy your holiday. Coming up, more insight on the question of the day. Are markets positioned for poor payrolls, and what do you do out of that? We're going to put the question to Anne-Katrina Peterson, Senior Investment Strategist at BlackRock Investment Institute. This is Bloomberg.
the labor market is starting to show signs of meaningful weakness outside of tech and financial services, which is obviously a lagging indicator. And without the labor market staying this tight, it's virtually impossible to avoid a recessionary outcome at this point.
Trogaevsky, FS Investment Solutions Chief Market Strategist, a little earlier on Bloomberg Television. Let's get back to our question of the day. Are markets positioned for poor payrolls? We have seen a significant slide at the front end of the curve this week. And Catherine Peterson, BlackRock Investment Institute Senior Investment Strategist, joining us now. And Catherine, the market has got very pessimistic very quickly. And I'm wondering whether you think this is an overreaction. The yield we've seen at the front end of curves on both sides of the Atlantic this week has been brutal. Have we gone too far too quickly?
Well, I think that what market pricing currently reflects is a strong disconnect between sticky inflation on the one hand, which is supported by ongoing wage pressures, given the tight labor market in the US, and on the other hand, Fed rate cuts. And you mentioned the front end rally this week. US Treasuries 2 years down more than 30 basis points this week. And while we also acknowledge that the US Fed is now entering a more nuanced phase of curbing inflation, meaning less fighting, it will not cut rates in 2023 in our view.
So when do you think the market's going to change its view then? I mean, the disconnect just keeps growing. It's not resolving. And
Well,
Katrina,
I think
Alex?
that,
Yeah.
yes. Thank you, Alex. Yeah, so for example, when looking at tomorrow's US labor market data and then also next week's CPI, which will likely continue to show sticky core inflation well above the 2% target, those two data points may give an impulse to markets to reflect the Fed cutting views. When you think about labor market payrolls tomorrow, the consensus is of one of decelerating payrolls in March, which is no surprise given the high numbers in January and February, which were partly due to mild weather-related effects. However, even if we do see consensus figures of around 240,000 jobs being created in the US in March, this is less than in January, February, but this is still signaling a strong labor market, more than roughly double what Fed Chair Powell would suggest would be a labor market or employment growth that is consistent with the inflation target in the US. And then heading towards the CPI figures next week, while we might see falling headline inflation in March due to energy-related base effects, the core will likely remain sticky well above the Fed's target, and hence that would be another sign or impulse, could be, for markets to reflect the current cut views.
You're painting a picture where equity markets and bond markets fall at the same time, Anne-Catherine. When do you think that starts to happen? When do we start to see that turnaround? Because at the moment we've seen equity markets being reasonably resilient, we've seen bond markets being bid. I wonder if we're going to get back into a position where both have the potential to fall at the same time.
Well, I generally like to, would prefer to get rid of that notion of being bearish or bullish in equity markets or bonds as a general statement. I think in this new regime that we live in, that investors have to embrace, a new regime of higher market volatility, which has also played out in the first quarter of this year, it's more about looking for relative opportunities. Where do we see these in equities and bond markets right now? In equity markets, we continue to prefer emerging market equities over developed market equities, given the very diverging earnings trends. Earnings look too rosy in developed markets. Earnings do have potential for a boost in emerging markets given China's restart. In fixed income, looking at government bonds, for example, we continue to like the very short end in government bonds for income, while we still are underweight the longer end, given Fed mispricing in our view, given ongoing quantitative tightening, debt loads. So overall, a higher term premium that still needs to be priced by markets.
Where about the earnings revisions? I mentioned Mosaic earlier, and sort of now we're starting to see, okay, maybe the comps will be really bad, that the tailwinds that we saw the last few years may now become headwinds. How fast and furious can that sort of downgrade cycle be, and how quickly do you think the market's going to react?
Markets have downgraded their earnings expectations, but in our view, there still remains some potential for disappointment, particularly when we look over next quarters. In the second half of this year, we do expect both the United States and Europe fall into recession, a recession foretold, engineered by central bank tightening cycles, and this will of course have implications both for earnings but also for risk sentiment in our view. And I'm always puzzled by this discussion about nominal earnings keeping up so well. As a matter of fact, when we look into history, for the S&P 500, for example, nominal earnings or S&P 500 EPS growth has been in recessionary territory, has taken a hit even when nominal GDP growth was holding up well, and I believe that investors have to bear that in mind when looking into the second half of this year.
All right, Ann-Katrine, thanks very much. We really appreciate it. Ann-Katrine Peterson, BlackRock Investment Institute Senior Investment Strategist. We appreciate your time. All right, coming up, the other big story, of course, Ursula von der Leyen and Macron in China. So Airbus is now planning on doubling its production capacity in China. We're going to get the latest details behind that move and what it signals about Europe and China relationship and kind of the U.S. in the middle there. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Simone Foxman. In the UK, a sign that homebuyers have adapted to a surge in interest rates. One of the country's biggest mortgage lenders says house prices are stabilizing after a decline last year. According to Halifax, the average cost of a home rose 0.8% in March, the third monthly gain in a row. Europe is looking for a level playing field when it comes to trade with China. EC President Ursula von der Leyen brought up the matter with China's Premier Li Keqiang in Beijing.
Our trade relationship is increasingly imbalanced. So over the last 10 years, the European Union's trade deficit has more than tripled. It reached almost 400 billion euros last year. And we discussed that because this trajectory is not sustainable and the underlying structural issues need to be addressed.
Von der Leyen is accompanying French President Emmanuel Macron on his trip to China. Meanwhile, Airbus will double production of its best-selling single-aisle jet in China. It's a bold bet on the future demand for air travel and aircraft orders in one of the world's biggest aviation markets. The move in China is a key part of Airbus's plan to increase production of the A320. And that's your Bloomberg Business Flash. Guy.
Simone, thank you very much indeed. Let's carry on our conversation with that Airbus story and bring in Bloomberg's aviation reporter, Siddharth Phillip. Sid, there was hope, I would imagine, at Airbus that we were going to see a trip, Guillaume Faury, the CEO, going with Emmanuel Macron, and that was going to result in some big orders for some wide-body aircraft. We understood that they were hoping to sell some A350s. Instead, all they did was go to China and spend some money on a new plant. This may be not the result that Guillaume Faury maybe was hoping for.
Yeah, I think that is some sort of a worry for Airbus, although Guillaume Faury did say that they are in discussions with customers in China and looking to convert some of the discussions into orders. But again, nothing at the moment, and instead they're spending a lot of money on building a new assembly facility for the A320, which is they already have one plant, and they're expanding capacity, so virtually doubling capacity in China.
So Sid, Macron was talking about you want to de-risk, not decouple from China. What does a de-risk but not decouple look for Airbus at this point?
So Airbus has a pretty diversified manufacturing base. Unlike Boeing, which is concentrated in the US, Airbus has manufacturing plants across the world, including in the US, in Europe, and in China. So they have a fairly de-risked production strategy for their best-selling A320 model. And essentially, they're looking at ramping up production all the way to 675 planes a month by 2026. And for that, they need to sort of ramp up production everywhere. And so Airbus says ramping up production in China is a crucial part of being able to ramp up production for their overall global goal.
Isn't Guillaume taking a huge risk here, though, Guillaume Faury? We've learned the lesson that you can get stranded assets. We've seen that with Russia. Geopolitical tension is ratcheting higher. How big a risk is he running here?
So, I mean, Boeing has been largely shut out of the Chinese market for the last couple of years. I mean, after the MAX, there was a sort of tensions between the US and China. And so Airbus has secured some massive orders from from China, and essentially they're looking to deliver those planes and actually ramp up production in order to make sure Chinese airlines have planes.
But if the geopolitics gets in the way, isn't there a danger? We've seen this with German companies in Russia. You can't get access to those assets. You've got to sell those assets.
Yeah, I mean, I guess that is a calculated decision that they've taken, that essentially at the moment the size of the market, I mean, China is about 20% of the global aviation market. So they've decided that 20% of the aviation market is the risk that's worth taking in order to get a bigger presence there.
So, Sid, I hear what you're saying in terms of diversifying their manufacturing plants, et cetera, and that China's 20% of the global aviation market. How diversified then can Airbus get globally, to Guy's point, where if China goes under or there's some real decoupling there, the Airbus won't get hit as hard?
So it is hard because especially at the moment, airlines are placing orders for planes that will be delivered in 2027, 2028. So it's really hard to plan ahead in terms of the sort of dynamic nature of how geopolitics works. So it will be something to be seen, and especially as delivery dates get closer. Airbus does have a large order book that's sort of concentrated in the US, India. They made a sort of large order with the Air India deal. So they do have some sort of de-risking in terms of not putting all their eggs in Chinese basket, but it does seem like it's going to be a tricky situation if the sort of political tensions rise there.
Sid, we're going to talk luxury in a second and their exposure to China as well. What kind of reopening boost are we learning through the airlines right now?
So the airlines, like everywhere else, air travel in China is coming back as travel restrictions are eased. And so everyone's sort of bringing back capacity really rapidly. And so there's a lot of demand for planes, there's a lot of demand for travel. And essentially, it's all about ramping up capacity in order to meet that demand, similar to how it is across the world.
Sid, have a great weekend. Big day today. Thank you very much indeed for joining us and wrapping it up for us. Siddharth Phillip from our aviation team. Let's take a quick look at where we are. We're heading into the end of the day here in Europe. Not long to go until the end of the session. I want to flag to you a call that has been made by Andrew Garthwaite and the Credit Suisse team on UK equities. Now, up until now, they've been reasonably positive because of the valuation story for European equities. So for UK equities, sorry. Today, they've gone into overdrive on it. Basically, they've gone to a kind of massive overweight. They think it's such a compelling story that this is a market you simply cannot ignore right now. Over the last year, the market is up by 1.96. One of the few markets over that period that is in positive territory. Shell, a positive note out there, positive story out there when it comes to their gas trading. That stock on a two-day basis up by 2.35. I want to show you the 52-week highs as we come in towards the end of the session here. Thales, Dassault Aviation, both trading strongly. Carlsberg up, Air Liquide up quite nicely as well. A whole series, a continuation of a series of 52-week highs. European equities are higher today. The close is next.
Great questions.
Easter weekend is almost upon us. Slight volume characterizing European equities today. I think no real surprise there. A little bit of a flip round in terms of recent positioning as well. Andrew Garthwaite's notes over at Credit Suisse. Maybe well timed. The FTSE 100 up by 1%, outperforming some of the European markets today. The DAX and the CAC 40 up a little bit. The CAC 40, which has been driven to record highs by the luxury sector, seeing a little bit of a reversal in that space. So let's talk about how the session has developed. As I say, it has been one that's been delivered upon light volume. We have seen, we're not off by much, we are off by a little bit. So we have seen basically a reasonably choppy session. This feels like a pre-holiday kind of weekend when we got 4 days off here in in Europe. That chart is going to appear any second now, I absolutely promise you. But let me tell you that what we basically had here, there you go. Look, I told you, as if by magic. We're up by around 0.5%, but as you can see, basically a very tight range. We've not really been delivering much in terms of a direction today, a clear idea of where we're going. I think people basically have been maybe de-risking. 4 days off, how much risk do you want to carry through those 4 days? So that's the picture we see from the stock 600. I think the sector story in the single stocks, though, we do get a little bit more interesting. So look at this. Real estate up today. Insurance banks tracking a little bit higher. But real estate, I think, is interesting. So real estate has been the underperformer of late. It's been very choppy. We're all concerned about what's happening in the CRE space. The luxury sector, which is represented here by CPNS, right down there at the bottom, has been the real outperformer. It's driven the French market, as I say, to record high after record high. And that sector has been delivering 52-week high after 52-week high. Look at that. So the real estate is up today, and the luxury is a little lower. Now, remember, next week we're going to get Hermès numbers. So we're going to start getting an idea of what is going on. Though I think Hermès is maybe a little bit different to the rest of the sector in terms of its pricing power. Let's just dwell on some of the single stocks. I mentioned a little bit earlier on. If you are looking for an idea of what is happening with the consumer here in Europe, look no further than what is happening with the travel sector. And TUI is a really good example of this. The stock is up by 9.65% today. Remember, it's having to rebuild its balance sheet. But today it was talking about this idea that it thinks it's going to have a summer that is going to be back to pre-pandemic levels. The consumer in Europe wants to spend money and wants to go on holiday, and TUI is going to allow them to do that, and it's certainly going to bank the buck from it. And it's interesting to see just how big a reaction we are getting, and a positive reaction at that. Airbus is up by 1.4%, despite the fact we didn't get a big order, a big 350 order coming out of China announced today. And then we come to Kering. Now, UBS was out with a note yesterday talking about what is happening in the luxury sector, maybe pouring a little bit of cold water on Kering. That stock is down by 1.89% today. But as I said just a moment ago, Alex, we are seeing the luxury sector coming under a little pressure today. Now, I'm not sure that's got anything to do with Emmanuel Macron being in China today, which has been such a key driver of what has been happening with the luxury sector. I think it's probably more to do with maybe actually positioning and the market having such a great run. Now that takes us on to what is happening next week. Next week, Monday, we are not going to be here. Alex, I think, is going to be here.
I am.
I will not. The Easter weekend, yeah, exactly. Tuesday, Swiss Parliament has hearings on Credit Suisse. Keep an eye on that. I'm not sure what's going to come out of that. Tuesday, Wednesday, I think Thursday and Friday, actually, to be honest, Joe Biden is going to be in the island of Ireland, visiting both Northern Ireland and Southern Ireland. The Good Friday anniversary is on Monday. Thursday, it's going to be fascinating to see what happens with GDP. And then Friday, we get back to the luxury sector. Hermès sales are going to be out. The maker of the Birkin bag, in some ways, the ultimate kind of Veblen good. The higher the price, the more people seem to want them. But certainly it has a different pricing model than we see maybe elsewhere in the luxury sector. But it is, Alex, as I say, emblematic of what has been a fantastic run for this space.
Yeah, and I love this as a jumping off point. So yes, we're going to get the Hermès numbers next Friday. So let's just take it in a broader context. So Hermès hit a 52-week high this week. Now, one more sign of this luxury outperformance. So check out the MSCI Luxury Goods Index. It's outperformed the overall world index and just like blowing past its trading range for the year. So let's get more in the luxury space. We're joined now by Swetha Ramachandran, GAM Investment Director. Swetha, I ask you this every time. How much more upside is there to these luxury names? And how do we get there?
So the story for 2023 is really very much about the recovering Chinese consumer, and that's where the upside is going to come from. Ever since China's reopening towards the end of last year, a lot of enthusiasm has been built into the sector and the sector's shares about what the recovering Chinese consumer, and especially the traveling Chinese consumer, could mean for the prospects of the companies in the luxury sector, given the sector's particular reliance on this consumer cohort. Prior to the pandemic, Chinese nationals made up 33% of the sector's revenues. That has come down substantially because of the absence of the Chinese from the world stage on the tourism front, but also because of domestic pressures in 2022 from the lockdowns. And all of that is reversing now, which has built huge optimism about what a recovery from the Chinese consumer could mean.
How much of that, though, is already in the price, Swetha? Good to see you. We've come a long way very quickly, and I imagine most of that is built on China. Is there more still in the tank? How much better can it get?
So I like have to look at 2021 earnings upgrades for the sector for the index that you just mentioned, the MSCI Textiles, Apparel, and Luxury Goods Index. If we look at 2021, from the start of the year to the end of the year, we saw earnings upgrades on average for the companies in the sector of between 50 to 80%. So 80% was more the hotels companies, which had obviously been beaten up very badly in 2020, and between 50 to 60% was companies like LVMH, like Hermes. Those were the kinds of upgrades that we saw in 2021. In 2023, year to date, even with the expected recovery of the biggest consuming group for the luxury sector, earnings upgrades have been far more tepid. And so this is really where I think the taps have yet to be fully opened, and that the upcoming results season, starting with LVMH next Wednesday, then Hermes on Friday, will provide a catalyst for people to get more comfortable with the idea of the Chinese consumer recovery.
So we hear this a lot in terms of, say, commodities, right? Like the closer you get to China, the more you believe in the China reopening story and again, getting bullish. In a medium term, though, are these guys going to be at a disadvantage? I'm just pointing out to Ursula von der Leyen, talking about the trade imbalance between the EU and China and how something has to give and sort of the de-risking versus decoupling. Are we going to get to a place where the luxury guys are so focused on China that that becomes a real material risk for them?
So I think what's really interesting about the luxury sector is that dependence on the Chinese consumer has massively reduced in the last 3 years. It is true that in 2019, not only were the Chinese the biggest single driver